The S&P 500. Let me start with a number that should not be comforting and then show you why it is. 27. That is roughly how many times out of 100 the S&P 500 has finished a single year in the red. More than 1 in 4. Put your money in this market on a random Tuesday and check it exactly 1 year later. History says that you had about a 27% chance of looking at a loss. That is not a rounding error. It is a real repeating uncomfortable fact about owning stocks. Now, hold the same money for 20 years, the same index, the same 500 companies, same wars, same recession, same panics, and the number of 20-year stretches in the recorded data that ended with you down money is zero. Not low, zero so far. Nothing about the companies changed. The only thing that changed was how long you were willing to wait. The S&P closed on Friday at 74.89. Inflation just came down. The Fed just held rates, and 3 of its own members voted to raise them. So over the next 10 to 15 minutes, how to read this chart, where today's market sits on it, and how to actually use it. Quick note, if this is useful, hit subscribe to the Black Swan channel because this is a chart work. We do that every single day. And if you want the deeper layer, join as a member. And don't forget the thumbs up. And most people see a motivational poster here. I want you to see a measuring instrument. The source is Novell Investor using S&P 500 rolling total returns from 1926 through 2013. 88 calendar years. And here's the raw facts on the top bar. 24 of those 88 years ended in a loss. 24 divided by 88 is 27%. It's a count, right? So the world rolling matters. We're not just looking at January to December. We slide a window across the whole history, every possible start and every possible end for the 10-year bar that gives 79 overlapping windows, 95% finish positive, which is why the loss figure reads 5 in 100. Now look at the shape of the retreat. 27, then 14, then 5, then 0. There's not a straight line. The biggest single drop happens between year 1 and 5. You cut your historical chance of loss roughly in half just by going from 1 year to 5 years. That is the cheapest risk reduction available to a normal investor, and it costs nothing. No fee, no product, just patience. One more thing. That bottom bar reads 0 so far. Those two words are doing real work. The honest version of this chart is not the market cannot lose you money over 20 years. It is that it never has yet, across roughly a century containing a depression, a world war, and 2 crashes that cut the index in half. I guess we're saying you can't lose money in the stock market if you hold it long enough. Let's flip this on its head because your brain handled this version better. A 73% chance of a positive year, 86% after 5 years, 95% over 10 years, and 100% of recorded 20-year windows positive. Now, I want you to be straight with you about what 95%, because that is where a lot of finance content gets sloppy. Go looking and you will find different numbers. Withrop Wealth ran 978 rolling 10-year windows from 1928 to 2019 and got 93% positive. Bank of America Global Research puts a negative case near 6%, so about 94%. Our source chart says 95%, which is right. Well, all of them. Yeah. Different start years, different end years, monthly windows versus annual windows. Move the goalpost a decade and the number moves a point or two. The precise decimal is not. The insight is that 3 independent groups using 3 different methods across nearly 100 years all landed between 93 and 95. When independent measurements cluster that tightly, you're looking at something structural, not an accident. And that thing has a name. Over long periods, you are not betting on prices. You are betting on 500 companies continue to earn, adapt, replace their weakest members, and pay out cash. That has been a very good bet for a very long time, not a certain one, a good one. Take a look at this chart. Theory is easy. Let me show you this chart running in real time this year on your money. Rewind to late February. The conflict with Iran escalates. Oil spikes. Brent up $80, then later run past 100. By the end of March, the S&P 500 had wiped out its entire 2026 gain. On the worst days, close to 90% of the index was red, and decliners beat advances 17 to 1 in the New York Stock Exchange. If you're watching your account, then every instinct was screaming sell, and the headlines agree with your instinct. That is what it makes it hard. Now watch what happened next. In April, S&P rose 10% in a single month. Year to date went from negative back to positive 5.7. In May, another 5.3%, closing the month at a record. Year to date, 11.3%. Friday's close was 74.89, up roughly 9.4% on the year. The 52-week low back in that panic was 62.71. From that low, there it is, about 19%. And here's the part almost nobody talks about. Schwab measured the average S&P 500 member drawdown at about 20% year to date. The average stock in the index fell more than 20% at some point this year, while the index itself finished up. Underneath the calm surface, individual holdings were getting hammered and recovering at different times. That is the odds chart compressed into 7 months. Short windows are violent, long windows are boring, and boring is where the money is made. So this is where history gets interesting, where most explanations get it wrong. People say time makes stocks safer. That is not quite what happens. Time does not raise your average return. What time does is shrink the range of things that can happen to you. Look at the 1-year bar. Best calendar year in this data set, 1933, up 54%, worse in 1931, down 43.3%, a spread of about 97 percentage points. Two people can buy the identical index 2 years apart, and one triples while the other is nearly wiped out. Now, the 10-year bar, right in the middle, best rolling stretch, around 20% a year starting in 1949. Worst, about negative 1.5 a year starting in 1999. Still wide, but the catastrophe is gone. The worst 10 years in modern history cost you roughly 1.5% a year, not 43%. And the 20-year bar are totally to the right. Every rolling window from 1928 through 2005 finished positive. The worst still compounded at 3.1% a year. The best at 17%. Sit with that worst case. The worst 20 years an American stock investor could have picked in the last century still roughly double their money. That is the floor, not the average, the floor. And remember, what those windows contain, they contain the 1929 crash, the Depression, World War II, stagflation, Black Monday, the dot-com collapse, 2008, the pandemic. Everyone felt like the end at the time. Everyone is already inside these bars. So let's take a look at the background, right? The backdrop right now. So where does today sit? Because context changes how you use everything I just showed you. Inflation started 2026 at 2.4%. Then the energy shock hit. April 3.8%, May 4.2%. The highest is more than 3 years. Then June came in at 3.5%. Consumer prices actually fell 0.4% in the month, the biggest single month drop since April 2020. Core inflation, stripping out food and energy, is down to 2.6%. That is the good news, and it is real. The energy shock looks like it's passing through rather than embedding. The Fed met on July 29 and held at 3.5% to 3.75%. The vote was 9-3, and all three dissenters wanted a hike, not a cut. Chair Kevin Walsh was blunt on the soft inflation print. His words, "That is not my view." Meanwhile, the 10-year Treasury was run near 4.6%. The VIX closed Friday just under 16, which is calm. There is no FOMC meeting in August. So the real signal is Jackson Hole this month, then September 16th. And this is the midterm election year. That brings up its own volatility. So inflation improving but above target. The central bank leaning hawkish. Yields elevated. Stocks near record with a comfier gauge. There is generally uncertainty in the 1 year window, which is exactly the window where the odds chart says 27 in 100. What time does to $10,000? Would you like to know? Well, let's make this concrete because percentage do not feel like anything. $10,000 divided, we're going to reinvest the dividends for 20 years. At the worst 20 year ever recorded, 3.1% a year, you finish with about $18,400. At the long run average of 10.08%, about $68,000. At the very best ever recorded, 17.7% at $260,000. Now look at that spread. The gap between worst and average is enormous. But the worst case is still positive. You're not choosing between making money and losing money over that horizon historically. You've been choosing between making a little and making a lot. That reframe changes behavior. Most people manage a portfolio as if the question is if I lose everything. Over 20 years history says the real question is how much will I compound? Those are two different emotional states and they produce two different decisions when the market drops 15%. So here's a practical use. Split your money by when you need it, not by how you feel. Money you need inside 3 years should not be at this chart at all because this is a 27 in 100 zone. Money you don't need for 10 years or more belongs in the bottom bar. And if the money you leave alone hardest when headlines get loud. What everybody's saying here. This chart does not end fear by promising you will win. It does not. Over the next year, roughly 3 in 10 says you are down. Plan for it. What it does is show you where your edge actually is. Not stock picking, not timing the Fed, not calling the next almost headline. Your edge is a decision that costs nothing that most people refuse to make. Define your holding period in advance, then honor it. The chart says it plainly. Same companies, what changed was time. That is the edge. If this was useful, subscribe to the Blacktron channel and do become a member. Now, I know that I meet with all of you every day, at least my members, at 9:30 a.m. to talk about the portfolio, which right now my portfolio is beating the S&P 500, as my members already know. I come to you with 10 separate tools that you need in your tool chest in order to understand what's happening in the market. Now, of course, 20 years is a long time, right? So it depends how much time you have left. But overall, just sit and wait.